This is a paper where the motivation was to understand how economies and how economies respond and adapt to large financial shocks. Financial shocks occur very regularly. So in advanced economies, we have banking crises roughly every 3 decades in the last 2 centuries. In the UK and the US, this occurs roughly every two decades. Now, we have very well estimated firm level results that there are severe consequences when banks sharply withdraw their funding. So we know firms invest less, they hire fewer people, they're generally less productive. But we don't know nearly as much about the longer term consequences. So classical work and macrofinance like Kiyotaki Moore or Bernanke and Gertler, which have this financial accelerator type of mechanism where the financial sector shocks propagate into the real economy, also imply that the effects of those shocks will wear off and maybe even reverse once the financial sector has recovered. So in addition, we have very little evidence on what happens for international trade in a global sense, being able to look at all the countries that are trading, with whom and to what extent. So I'm going to tackle those questions by using a historical natural experiment, which occurred in London in 1866. So I think this is a nice setting because during this period, London was the center of the global financial system, which means that British multinational banks were funding exporters through their subsidiary offices in cities around the world. Now, these banks were the dominant providers of trade credit, and I estimate that they are providing on average about 90% in any given city. These were banks that were also operating pretty much everywhere that was relevant for international trade at this point, in countries that accounted for 98% of the value of world exports. Okay. One thing to mention here is also that these banks were funding trade between all countries. So we're not just thinking about trade to and from the United Kingdom. So during the crisis itself, 12% of these banks in London, which are headquartered in London, fail. And so this means that their subsidiary operations abroad immediately close. And so these bank level shocks are going to be the source of my variation for a given location's exposure to these bank failures. Okay, and so given this exposure to the shock, then I'm going to estimate the impacts on international trade, which is a really relevant sector for this particular shock because these are banks that were chartered and created to supply trade credit. We know that exporters are particularly sensitive to the cost of external financing, and there's this slightly older theoretical literature that shows how there can be path dependence even from a very short-term shock in terms of who's trading with whom. And so in terms of the data, the outcomes, I'm going to be looking at exporting in this long period from 1850 all the way to 1914, while explicitly keeping track of banking sector recovery. Okay, so just as a preview / further motivation for this setting, what you see here is the total aggregate exports between the groups of countries that are more or less exposed to the shock in 1866. All these lines are normalized to equal 1 in 1866. And so the group of countries that have higher exposure are really stagnating in terms of their overall exports growth, while the ones that have a below average exposure are taking off. There's this clear cross-country substitution in who seems to be exporting significantly. Okay, so I'm going to show you that there are large immediate effects within and across countries on both the intensive and extensive margins. I'm going to focus the presentation on the long-term effects at the relationship level, which shows that in terms of bilateral exports at the relationship level, the average importer is going to buy significantly less from an exporter that is more exposed during the crisis. And this effect is going to last for about 4 decades. And the mechanism in mind is one that is slightly adopted from the Baldwin work in the late 80s, which is that in a world with substitutable exporters plus very high sunk costs of search or establishing relationships, this shock to financing is going to effectively raise the final price of these exposed exporters. They're going to be disadvantaged in forming new relationships with any given new trade partner. Sometimes it might be the case that their pre-existing relationships are severed because other exporters are so much more competitive given this shock. And then afterwards, these sunk costs are going to prevent them from returning to where they had been prior. Okay. All right. So in terms of institutional context, there's the reason we need bank intermediated trade finance is based on some theoretical work that Tim Schmidt-Eisenlohr has done, Antras and Foley. It's also in Kalina Manova's work. Basically, exporters need working capital during these long periods of shipment, and payment in advance isn't going to be possible when there's high contractual frictions. Okay, so your importer isn't going to be able to finance you. You yourself can't finance this period. And so banks are actually very well positioned to deal with this friction because they operate locally and they have much better knowledge to fund these risky exporters. They're also able to collect collateral and find other ways to insure themselves. And so this generates these standard sorts of relationship stickiness in banking that we're used to thinking about. The British advantage and part of the reason why they had such a intense and large network of banks is because they had access to the largest pool of capital in the world by issuing deposits and shares to British savers through their headquarters. They were then able to transmit these funds from London to wherever their subsidiaries were operating. And they lent abroad using a standardized guaranteed security known as the banker's acceptance, which meant that they were essentially guaranteeing the risk of a idiosyncratic exporter, say in Brazil. So this means that the securities that they're generating actually can recirculate as a security that has a much better known risk of the bank itself. And all of these banks, these major multinational banks, had access to the Bank of England's discount window, which essentially meant that the Bank of England was going to be willing to discount their securities. And this makes them essentially the safe assets of the day. There was a huge demand for these short-term trade credits in London by financial intermediaries, other banks. And so, these banks would remit these securities back to London, where they would trade on the interbank market. Okay, so all of this means that the locations that had access to these subsidiary banks, these subsidiary operations, had a lower cost of capital on average because of this lower cost of capital in London, but it also meant that they were exposed to changes in the cost of capital coming from shocks to the London money market. All right. So the crisis in the middle that caused one of these major changes in the cost of capital was the failure of the firm Overend and Gurney, which ultimately actually failed due to fraud and mismanagement. So Overend and Gurney was an interbank lender. Strictly speaking, it didn't lend directly to any firms. They didn't have overseas operations. They were just supposed to do this daily sort of trade in safe securities between banks. This was an establishment that had existed for centuries, and older generations had built up this firm's reputation and credit over many decades, but a younger generation in 1860 essentially had no interest in running this partnership. And so they delegated the business to, quote, wily sycophants who would then tunnel the funds. And Not too surprisingly, this management strategy didn't work out very well for the firm. And so in 1865, this is the year before the crisis, the partners were alerted that they had actually gone bankrupt. So they had the choice of liquidating or basically IPOing, issuing equity, and thereby gambling for resurrection. And so they chose to issue equity. And the unfortunate aspect of this is that the prospectus, this was a time when nothing was regulated. So the prospectus completely masked the true state of affairs. All it said was that, this new limited liability corporation is going to absorb the old business of the partnership. And the financial press, the contemporaneous financial press, herald this as a major investment that was going to do as well for the shareholders as it had for the firm for so many years. So when this firm finally announced bankruptcy about 9 months later, there was complete panic in London. And there were runs on pretty much all the deposit issuing banks. So the Times says that even the most respectable banks were besieged by their depositors. Ultimately, 12% of these multinational banks fail, and then their subsidiaries abroad close. Okay. So the empirical strategy that I'm going to use is going to employ the fact that the shock is coming from London, but it's going to be felt in the subsidiary operations. And so the measure that I construct is this measure called exposure to bank failure, which is just a shift share instrument where we have the shocks to individual bank growth rates. This is just the failure rates with the importance of a bank to a given location before the shock. Okay, and that's going to be the measure that I'm going to estimate with respect to exports. Okay, so the validity for the instrument comes from the exclusion restriction itself, and this is based on work by Baruziak, Hole, and Charavel, and Adal Colasar Morales, where what we need is just that the individual bank failure rates are orthogonal to characteristics of the locations that they're operating in along the dimensions that are relevant for exports. Okay, so as you can see, if the bank failures themselves are random, this condition will be met, but they don't need to be random. What we need is that the randomness between these banks and locations shouldn't be such that they're sorting along dimensions that are going to be simultaneously relevant for both the likelihood of banks failing and there being a decline in exports. Okay, so one example that we can think about is if we're seeing that all the banks that are operating in countries that are very intensive in, say, the cotton trade are failing at the same time as the cotton trade is collapsing, then we would be worried that there's some sort of simultaneous shock to the cotton trade, for instance, the end of the US Civil War, that's actually driving both of these things. So I'm going to deal with this set of concerns by doing the very standard things of showing you there are no pre-trends in the outcomes. Bank failure is mostly uncorrelated with bank characteristics, which seems to suggest it's pretty random. But more importantly, it's going to be mostly uncorrelated with the characteristics of the locations where they're operating. And then anything that's potentially confounder, I'm gonna include as a control. Okay. So the data for the instrument come from these ledgers, which document the details of every single at the time of the crisis. And what I do with these is I'm going to take a given bank's information. I'm going to know the location where they were lending using this leftmost column. So this is a number of cities in India, as well as Hong Kong, Rio, Boston, Paris. I'm going to know the size of the loan on the far right-hand side. And so the pre-crisis share is simply the amount of lending that came from a given bank B in a location over all the lending in that location. and interacted with these failure rates, which are very public information. So this gives us this picture of the underlying heterogeneity, which is what I'm going to use to estimate, which is the exposure that any given origin country has to the shock. Okay, so I'm going to basically immediately after the crisis, this is like in the 1 year window, we see a lot of large effects on both the intensive and extensive margin, which I'm measuring using port level shipping activity. In the long term, I'm going to use just a bilateral trade data set that I've put together from a number of different databases that other researchers have spent a lot of time on. And I'm going to estimate a dynamic difference in exposure. Okay, so the left-hand side is a log of exports from an origin country O to a destination country D in year T. And we want this beta parameter estimated during these annual or 5-year intervals with respect to an origin country's exposure. We can include origin country controls, origin fixed effects, and then destination year fixed effects. So this set of fixed effects is particularly important because we're going to deal with, aggregate demand shocks from the importer side. Okay. So the picture you get of the estimated coefficients looks like the following, where before the shock, you're not seeing any differential effect in terms of how much a given buyer is going to be importing from these more or less exposed exporters. But immediately afterward, there's this large decline. And in fact, it gets worse over a few years before there's a slow pattern of recovery. These are the coefficients estimated in 5-year intervals, and they're just it's a cleaner way to see this these long-term changes. So to be super clear, I'm not showing you a decline in aggregate exports globally. This is a partial equilibrium result, and all it's saying is that, you're much less likely to buy from these guys that are exposed. Given that world trade is not declining in terms of the global aggregate, what this is saying is that basically importers are going to be buying much more from the guys who are unexposed. And so so the set of persistent results is pretty robust to all sorts of controls, contemporaneous and pre-crisis. And so what I'm going to do in my very last minute, I'm going to show you some heterogeneity, which seems to point to provide some supporting evidence for this particular mechanism. Okay, so the story is that the financing shock is raising exporters' trade costs. Okay, and so importers are going to buy more from these guys that are unshocked. And they're going to especially buy more within the industries where they were buying things from their old trade partners. So the prediction would be that exporters are going to benefit when their competitors, in terms of what their competitors are exporting, are shocked. And so the exercise that I do here is going to try to capture that essence of switching among competitors. What you have in the orange line is a country's own exposure to the shock. And again, you have this very slow pattern of recovery. What I've done with the blue line is I'm asking, all right, let's take the bundle of goods that you're exporting. Let's find the set of countries that are most similar to you in terms of the bundle of goods that they're exporting. And let's calculate their average exposure. Now, does their average exposure to this crisis help your exports to a given destination? And keep in mind, I'm still only using total trade value, so I don't have industry level bilateral trade. But even so, you see that there are these positive effects of having your competitors exposed to this crisis in a way that makes you that makes your exports to a given destination higher. Okay. Um, I'm just gonna wrap up here because I have technically gone over time already. So this was a setting where, first I'm able to estimate the causal effect of bank failures on this major type of macroeconomic activity. And then I'm finding that there are these both immediate and long-term effects on trade relationships. In terms of just a quick discussion and thinking about the relevance for today, a lot of models, especially in macrofinance, but also in international trade, don't allow for this the result of these persistent effects, but there is increasing empirical evidence that path dependence is showing up in a lot of different contexts. And so when we think about trade policy, the main implication is that even a temporary but sharp increase in trade costs can disrupt these relationships and therefore uh, make the effects of these this trade policy last much longer than the policy itself might last. Okay, thank you again for allowing me to present.
Thanks to you, very interesting paper. There is Johannes and Beata who have asked to intervene, but before that, Dan Treffler has sent a message saying that unfortunately he had to leave for a meeting, but he was kind enough to send you a comment. He's quoting his work with Dipple and Grief on the same period, and what he's saying is that London houses extended trade credit to British West Indies planters, conditional on the planters shipping their sugar to London to the merchant that extended the credit. While the natural market to sell into was the US. This meant that all of the ships needed to move sugar were on routes in and out of London. A financial shock stranded the planters not only directly in terms of credit, but in terms of their customers and shipping routes. So the impact would even be bigger in that case. So that's essentially his comment.
Yeah, I really appreciate that in-depth knowledge of the institutional context. Yeah, so that I believe that completely, and you do actually see that empirically. So places that had a stronger trade relationship with London ex ante um, do appear to be systematically more affected. So that is a degree of heterogeneity that you can look at, and presumably exactly for the reasons that he detailed there.
Beata?
To follow up on this question, so presumably British banks were more likely to be present in locations that had closer ties to London. So how do developments within the British Empire and the relationship between Britain and other countries have affected things over time? So what else has been happening that could be a confounding factor?
Yeah, that's a great question. So, from the perspective of just identification, it doesn't matter so much that British banks were maybe more intensive in certain places relative to other places, as long as the likelihood of banks failing, based on what, so for instance, are banks that are more heavily operating in the British Empire more likely to fail than banks that are less heavily operating in the British Empire. So as long as that balance condition is met from an identification perspective, I think we're not necessarily more concerned. From a heterogeneity and sort of mechanisms, channels perspective, you're entirely right that there are definitely other, aspects of the institutional context between, say, being in the British Empire versus not, that would perhaps exacerbate or dampen these effects. So I do a lot of those sorts of heterogeneity type exercises. And actually what I find is that the effects within colonies is much weaker. So basically there are very few persistent effects within the empire. So trade between imperial partners versus trade outside. And if you think about the fact that trade within the empire was structured using many more institutions than just bank financing. I think that that makes sense.
Thank you. But Johannes.
So a really fascinating paper. I liked it a lot. I also wanted to ask about the speed of the recovery, because I think the persistence of the effect is sort of this really striking and interesting finding, I think. So could you look by any chance at whether the how well communications connections are established between countries and whether that matters for the speed of the recovery? Like maybe with the idea that if it's cheaper to communicate at long distances, you may be able to find both more trading partners directly in other countries, but maybe also different sources of financing. And if I'm not mistaken, I think the telegraph connection network is being established around that time. And maybe you could look at kind of the emergence of connections and whether that matters for the recovery.
Jensi, I have a similar question actually, and following up on Johannes, I was also struck by the extent of the length of your effect in the long term. And I was wondering whether, thinking out of today, whether at the time there was an issue of finding easily substitutes in terms of trade versus today, where maybe it's easier to have access to information that allows you to more easily find a substitute, and therefore have a quick turnover of the value chain when you have like 30 years essentially of persistency. Thank you.
Yeah. So thanks for asking about that. So there are a few other things that I do, which I didn't show, but I think to your point, Carlos, what I do find is that places that do have ex ante better access to other sources of financing aren't subject to these persistent effects. So this seems to, this is in line with this idea that, if you're not in a position where you're going to be severing your relationships in the first place, then maybe you're going to be mostly fine. And also relationships that are closer by different ways of measuring them, so distance as well as institutionally closer. So this was how I characterized the colonial relationship, are also less subject to these persistent effects. But in terms of actually, tracing out the recovery patterns by thinking about looking at the fact that the telegraph network was growing was actually over time. That's not something I've done, and that would be very interesting to look at. So thank you for that suggestion.